Joining us now, Scott Wren from Wells Fargo Investment Institute. Scott, welcome. This feels like a dangerous moment for investors in the market right now. And there wasn't a ton of movement when the day was over. The Dow is just about perfectly flat, but there's the danger of standing still, right? Because if you had, sold out of the market earlier this year expecting things to go bad, you feel like a fool there. And also the danger of acting too rashly at this point. What should investors do based on what's gone on so far?
Well, John, for us, first let me say that, we're not chasing this rally. And what we've done is we've moved some cash into short-term fixed income, whether you're looking at 3-month, 6-month, 12-month bills, the yield's over 5%. So we're parking cash right now. We think we're going to have some sort of a pullback here. Is it going to be a 10+% pullback? I'm not so sure about that. But we think the upside's limited here. So we're playing defense right here. We took a little money off the table out of large cap, out of mid cap. And move that into some shorter-term treasuries.
Okay, but I think that's what investors probably need to figure out is how much percentage-wise do you take off the table, and then how soon do you start buying back in? I mean, is it like a 10% sort of thing when you've gotten this sort of move, even in the S&P just so far this year? And are you buying like a 5% pullback if you're not sure it's going to pull back 10?
Well, a 5% pullback, I mean, that can happen on complete noise. So I think that, of course, it doesn't pay historically to be out of the market for very long. So let's take, for instance, if you have a traditional 60-40 portfolio, we're more like 50-50 right now. And so I think we've been looking for the range, which granted we're at the top, above the top end of the range, 3,700 to 4,200 this year. Are we going to get down to 3,700? Potentially not, but we do think a pullback north of 5%, probably closer to 7 or 10%, can happen, and we want to make sure that we have a plan to step in and execute if we see that kind of a pullback. Now,
you're saying 50-50 equities, fixed income?
Yeah, I mean, if you're looking at a traditional 60-40 model, moderate growth in income, we're about 50-50 right now.
So, and I know that the short-term securities that you're talking about, the short-term debt in fixed income, that's not 50%. That's just a little bit. That's just, it sounds like dry
correct.
powder that you're putting aside.
Yeah, that's just taking some money out of equities and putting it in fixed income.
Given that it looks like we're going to be higher for longer, right? There's a pause right now, and the next move very well could be higher. How much are you building a fixed income position that you expect to ride for a long time? And then how much risk in fixed income are you willing to take, given the fact that, I don't know, companies seem to be holding up pretty well right here, might not get into too much structural trouble?
I think there's definitely some risk in the short term. And John, part of this problem is, is we've had everybody come into the year negative. I mean, just think of the people that you have on your show and the network has on their show. 90% plus people have been negative. They continue to be negative. And when everybody's leaning the same way to this magnitude, what's the market usually do? It moves the way to frustrate the most people, which in this case is up. So, we're not looking for much follow through here. We do think we're going to have an opportunity. As I think about the headwinds, in our opinion, at least from the Federal Reserve, they're not going to cut this year. The money supply is crashing. We think earnings estimates are too high. The curve's inverted. We can think of a lot of things that are out there that are going to be headwinds as we move into what we expect to be a moderate recession.